Many people know that when you reach a certain age in retirement, the IRS forces you to take money out of your pre-tax retirement accounts and pay taxes on those withdrawals. But did you know that there's a way you can take out these required minimum distributions and pay no taxes at all? It sounds too good to be true, but the IRS explicitly approves this and has a rule for it. By the end of today's episode, you're going to know what that rule is, who it's best suited for, and if you fit that profile, how you can implement this in your planning. Hi, I'm John Shear, and I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan-Ramel, and I've got a fee-only financial planning practice in Chicago, Illinois. And John, before we get going on taking tax-free distributions from IRAs, we just want to remind people to subscribe. If you hit the subscribe, people, it helps us reach more people on YouTube and helps us help more people.
That's right.
Let's get right into this.
I'm looking forward to this. How do we take advantage, right? Tax-free, especially it sounds like limited time only, right? Hurry up, but wait, there's more. And this is one of those things that it's like free, tax-free money. Absolutely. It's explicit in the IRS laws. And it's interesting. We were talking just a little bit before we hit record here is that, boy, not a lot of people know about this, and it can be a really big tax savings, right?
Absolutely. So we have clients that take advantage of this all the time, but we're doing this episode now. We're going to release it in October because we don't want people to wait until December to take advantage of this. Okay. And we'll explain the reasons why we like you to do this earlier, not at the very end of the year, even though it is charitable contributions. So I think about a third of all the charitable contributions are made in December. I don't know if you knew this, John, and and most of them are in the last week of the year. So, but we don't want you to wait until the end of the year. So, John, let's get into this.
Let's and you gave the foreshadowing there, right? What we're talking about with this is making what's called a qualified charitable distribution, and we get into the jargon, please. It's a QCD and all the fancy language, right? But what this means is when you're taking money out of your IRA, if you qualify, we'll talk about that in a minute. Taking money and giving it directly to a charity, there's no taxes that are due on that. And the IRS allows us, it's written in that for people that have to take these minimum distributions, and they change the law right now to say at 72, you have to start taking money out of your IRA account. Well, if you can take that money and you can give it to your church, you can give it to United Way, whatever charity, whatever nonprofits you give to, and that never shows up on your tax return. It's completely tax-free. And if you think about what this means, right, I put money into my 401k or my 403b or my IRA, and I got a tax deduction while I was working. Now I'm retired and I can take that money out and give it to the charities of my choice and not pay taxes. The charity doesn't pay taxes. It's one of the few ways we can have really, truly tax-free money and help to accomplish some of our goals.
Absolutely. And it grows tax-free while it's in your IRA too, or your 401k too. So it's really an awesome program. So let's get more into the details. There's another part too. So you need to make required minimum distributions, or RMDs, more jargon please, when you're 72. But a QCD, or a qualified charitable distribution, is available to you if you turn 70 and a half during the year. So there's that point of you don't have to make RMDs yet, but you can take QCDs. Okay,
yeah,
so
that's right.
That's people that are in that year and a half where they're not required to make distributions, but they can, if it makes the most sense to do their charitable contributions from their IRA, then we want to get them going on that.
That's right. And that comes from the old law. Some people might remember that it used to be that you had to take money out of those IRAs starting at 70 and a half. And that's where they said, hey, if you want to be charitable with us, we'll let you do it charitably. They changed the rules for when you have to take money out, but they didn't change the charitable side of things. And so that's sort of the scoop, right? That's what happens. You can take money from your IRA, give it to charity, no taxes at all. So where does this make sense? Right. So there's sort of two components as I see. I'll be interested to hear what you have to say, Bridget, but there's two places where I recommend people do this. Is number one, that they don't need the money out of their IRA. Like, listen, if you're spending money and your IRA is your source of cash flow, not a big deal necessarily, right? And then the other place is if I'm already giving to charity, if you're already giving to your church or to United Way or whatever your charity is, then this makes sense. If you're not, it's not like there's free, when you give this money away, you are giving it away, right? You're not using it yourself. It's a great tax deal. You avoid all the taxes, but it's got to reach your charitable goals and your goals for giving back, not for personal use. So those are sort of the two areas where I look at saying, listen, if you don't need the money and you want to give to charity, this is a place where it fits. How do you describe that? How do you talk about it with folks?
I look at it pragmatically as a tax strategy as well. And I think of it as if you're giving away money and you're not itemizing. So itemizing on taxes is charitable. You get a charitable contributions count as an itemized deduction. But after they changed the tax several years ago, a lot less people itemize now. I think it's probably 10 or 20% only that itemize, because they raised the standard deduction. And so people get more that way, but they don't itemize. So if people don't itemize, then this is especially attractive if they're over 70 and a half and give money to charity, or they just have a lot of money in their IRAs and they got to, they need to take the money from somewhere to give money away. So it's an effective place to do it. But I also want to make it clear that you can't double dip. So you can't you can't use your IRA to make charitable contributions and then take that same contribution as an itemized deduction. It's got to be one or the other.
Yeah, you either avoid taxes on the distribution or you pay taxes on the distribution, and you avoid taxes on your tax return, right? Not both situations. That's right. And it's interesting. So with that tax law change, and I always forget the exact numbers, but it's something like $26,000 for married folks and something like $13,000 for single folks. Like, listen, if your deductions from things like your mortgage interest and donations to charity are above those limits, that's where it kind of might not make much difference how you do your donations. If you're below that, it does. I sort of take the approach that if you fit the profile, right, you're over 70 and a half, and I want to give money to my church or to other charities, that this thing from the IRA is at minimum, it's not going to hurt you. And maybe it's going to be a super good deal, right? Like that sort of approach, just generically. Of course, your mileage may vary, right? Your specifics of your situation, but it doesn't hurt you if you fit those two things, I don't think, to be able to say, listen, I want to target giving to charity from my IRA rather than from my personal checkbook.
Right. And so there's a few, let's talk a little pragmatics here. So I think there's a maximum that you can actually contribute out of your IRA. If you're over 70 and a half to charity every year, I believe it's $100,000.
That's what I have. Yeah. Again, one of those numbers you can look up, right? It's some number, but it's a pretty big number, right? So, yeah.
So if that's something to be mindful of. Another thing is pragmatically, you have to give the money directly to the charity. So you can't take the money. I can't tell my custodian, hey, give the money to me and then I'll give it to charity. It has to go directly to the charity. And so that means that you have to have that information. You have to make that happen. And so charities generally want to help you because make that easy. However, there's a cool thing that a lot of people don't know about. I know we work with Schwab they're our custodian at my firm, and they will give our clients a checkbook from their IRA so that the client can directly write a check from their IRA to that charity. And you have to order the checkbook. So, do that right away. But the other factor is that sometimes it takes these charities a while to deposit their checks. So that's why we tell people not to try to do these in December, because a lot of charities are kind of pokey about actually letting the check clear. And it should be cleared before it really counts as a required minimum distribution. So I like to tell people to don't do this in December. Make sure you do it by the end of November.
Right. Right. Yeah, no, those are great. I learned that checkbook trick from you. There's other ways you can do it. We'd have people go online, you fill out the charity, or you call and get it done. So there's other ways to do it too, for sure. That checkbook thing from the IRA is a super idea. We use Schwab also at our office, but I assume most of the major custodians, if you have your money at wherever it is, that to take a look into doing that. And as you know, the other thing, as you just said, we've had some where you write a check and then it doesn't clear. They don't deposit it till January, and now you got this mess. And like, try to get it all done. And that's a good reminder then that this is a calendar year thing, right? For
Right.
making your minimum, especially if you need to make those minimum distributions. It's a December 31st thing, not a tax deadline, not April 15th. So this is a timely thing. If you're making these donations, make sure you take a look at getting that out and getting the charities to deposit those checks by December 31st.
Great. So I think this is a great place to wrap it up. So I'm Bridget Sullivan Mermel, and I've got a fee-only financial planning practice in Chicago, Illinois.
And I'm John Shear. I have a fee-only financial planning practice in Middleton, Wisconsin. Before we leave, don't forget to hit that subscribe button. That helps other people find this content on YouTube. And Bridget and I are both members of the Alliance of Comprehensive Planners. If you like what you hear on our show and you want to talk to somebody who takes a tax-focused, comprehensive approach to financial planning, check out acplanners.org. And with that, until next time.